and go. And thank you for joining our call today on why all the buzz about FTX, the HK-based crypto derivative exchange. Yeah, I'm excited for this call. I actually met Sam Bankman-Fried, the founder and CEO of Alameda Research and FTX, last month at the Asia Blockchain Summit. And it was a great conference. And for me, it was very eye-opening in terms of, the fact that the first killer app of crypto is speculation, and it's growing rapidly in Asia for multiple reasons, and in a way that it's not happening here or in Europe yet. But I think it'll come here. But in the near term, it's happening in a huge way in Asia, and it's growing. It's growing rapidly. And one of the companies that has the most buzz in the space is FTX, and I think with good reason. So I thought it would be great to have a call, and learn from Sam, exactly what FTX's plans are, and how they're looking at the market, and then hear from a couple different perspectives on FTX and what's going on. And so I'm excited that we're joined by Joe McCann, who's one of the best day traders in crypto, and also well known for Joe's Crypt, a Telegram group with over 6,000 active members. And excited also to have Michael Casely from Crescent Crypto, an asset manager in the crypto space, and they do a lot of interesting research. So super interested to hear what Michael has to say. And each of the speakers will talk for about 10 or 12 minutes. And then when they're done, there should be plenty of time for questions from the audience. And you can type in your questions in the chat function. And with that, I'd like to hand it over to Sam. Sam Bankman-Fried, founder and CEO of Alameda Research and FTX. Sam, you want to take over the screen?
Absolutely. First of all, thanks for having me. While I, stall for a minute as I get this up. So let's see if that worked there. Cool. So yeah. Thanks so much for having me here. I think I just want to start by giving a bit of an overview of what FTX came from, and why we sort of started this up. I guess some background on myself here. So I started my career at Jane Street Capital, about 4 or 5 years ago at this point, 5 years ago. And I was trading international ETFs there, doing sort of traditional quantitative trading on Wall Street. And I left that 2017, started up Alameda Research. And Alameda is a liquidity provider in crypto. And what does that mean exactly? It's a little bit, one sort of an interesting thing that's happened is that a lot of words that mean the same thing in traditional finance, market maker, liquidity provider, have sort of taken on very different meanings in crypto. But I guess the way that I would describe it basically is, Alameda is sort of a combination of, arbitrage, liquidity providing, OTC trading, quantitative signals, things like that, trading, about $1 billion a day globally across about 30 different platforms. So I was running Alameda for a couple years, and a bunch of things started to become clear. And one of them was that, there's a lot of infrastructure that could be pretty greatly improved in this space. And so I guess I'll start just by taking, you guys through a brief overview of what volume looks like across exchanges in crypto. Yeah, sort of the reality of where, the activity is happening. So the first thing is that, sort of as you alluded to, Asia is and has for a while been sort of the dominant force in crypto. What exactly makes an exchange Asians a little bit hard to describe, because you have places like, Bitfinex and BitMEX where they're really sort of international global companies, and it's hard to say for sure if they're best described as Asian. But but you know, Asia contributes something like 3/4 of all real volume in crypto. Um, and that's obviously, you know, it's pretty big, and I think that's something which is sort of obvious if you're, you know, in China, but in America, I think this is actually like really not obvious to try and figure out where is crypto really happening, what's you know, where is the volume going up, where are the biggest users of it. And why is it in Asia? Well, there are sort of a lot of reasons. I think one big one is like, you know, who are the most natural people to, you know, to have demand for crypto? Well, a lot of it's people who either don't trust their country's currency or who have, you know, a need to move money around the world. And uh, and that sort of fits the Asian economic scene a lot better than, for instance, the American one. Um, Another sort of thing worth noting about the ecosystem is that there isn't a lot of true spot fiat volume, which is say volume going up against like wire transfer based dollars. This has been true for a while, and uh, you know, stable coins they've been increasing pretty quickly, and they're way bigger, for instance, than U.S. dollar fiat transfer volume is right now. Um, And sort of the last thing that I'll say is that derivatives are big. You know, derivatives are more than half of all trading in crypto, and uh, and this has remained pretty constant. Uh, and I think this is again, it's a thing where if you trade on BitMEX, OKX will be, you know, Deribit, Bybit. It's sort of obvious that that's where the liquidity is in crypto. But if you don't, there's actually sort of a lot of skepticism from the outside, and a lot of people who like don't even know about half of those platforms. Um, and but you know, if you're sort of really trying to figure out where's the volume, where's the liquidity in this space, it's in the futures. Um, So, you know, a bunch of people have tried cataloging volume, and actually most of them have gotten it quite wrong. You know, you can look at CoinMarketCap, and 3/4 of the exchanges there are fake. Um, and on the other hand, you can look at things like the Bitwise report, which is sort of like America's, you know, attempt to catalog volume, and it basically said nothing's real but America's volume, and that's obviously wrong. And anyone who's traded on, you know, OKX or Huobi or one of the, you know, larger, really native Asian platforms knows that there's real volume there. There's also a lot of fake volume in Asia, to be clear, but there's also a lot of, you know, most fake volume is in Asia, but so is most real volume. Um, and anyway, one thing that we sort of did was, as one of the larger traders in crypto, we had a lot of experience with these exchanges, and you know, we sort of just know where the real volume is. And it's a thing you figure out pretty quickly if you're trading in this space, because you can just trade on the platforms and see where, you know, where do I actually get filled? Where can I actually get size off? Um, so anyway, we created a you know, compendium of real volume in the space. And it looks sort of like what you think, you know, with BitMEX, OKX, will be Binance as the four largest venues. Um, and one thing that you'll notice again is that the bulk of that is derivatives volume. Um, and you know, in addition, the bulk of that is really is Asian volume, and specifically China making up a pretty large fraction of that. Um, so uh, with that in mind, you know, derivatives being more than half of all volume, a lot of this being stablecoin based, and a lot of it being Asian based, you would sort of expect that, like, you know, amongst the most mature products, you know, the place with the most products, what you would find is a bunch of, you know, Asia based derivatives platforms. But in fact, there actually aren't that many. You know, there are only like 5 or so real large derivatives exchanges in the space, as compared to many, many fiat platforms, and many, many more stablecoin-based spot platforms. And the current futures exchanges have a lot of problems. And you know, sort of anyone who's used these a lot, the problems become clear pretty quickly. You know, a lot of these are not subtle. Um, you know, there's been hundreds of millions of dollars lost in the last year alone to clawbacks, And what's a clawback? That's when someone's account goes beyond bankrupt on a margin trading platform, and then all the other users are stuck funding it, basically. And that happens when there's just a failure of risk controls on the platform. So, so that's been sort of one of the persistent themes is really bad liquidation mechanisms, really bad risk controls. There's a lot of a lot of the derivatives volume is going up in places where it's just a huge pain in the ass to manage your collateral. Where if you want to trade a BSV future, you need to move spot BSV over. If you want to trade a Ripple future, you need to move Ripple over, and you can't funge them with each other. So if you decide you want to trade this BSV future, and now all of a sudden you want to go, long Ripple, well, you don't have any collateral in your Ripple wallet. So now you got to go get some Ripple over there. And it's just, a big pain to manage and requires you to be actively using spot as collateral, which is, part of the whole point of trading futures was to avoid having to do that. So, there are a lot of issues. And, another one obviously here is matching engine issues. Sort of very high profile exchanges where there's a minute of lag in getting an order through during busy times, which is exactly when you really need to get an order through. So, we looked at this space and we said, look, like half of all volume, more than half of all volumes going up in these derivatives platforms, there's only a few of them. They have really big issues. And there's a lot of inaction in this space, not a lot of initiatives to really solve this problem. So we started up FTX. And what is FTX? It's a crypto derivatives exchange. We have quarterly and perpetual futures on about 15 different products. The obvious ones: Bitcoin, ETH, EOS, XRP, etc. But we also have futures on some indexes. So if you want to trade an altcoin index, you can do that. We have futures on BNB, HT, and OKB, which are sort of really important coins in the crypto ecosystem that just didn't have derivatives. We have leverage tokens, which are basically 3x leveraged ERC20 tokens. And the key thing about them is that you can just interact with them like spot tokens, but still get leveraged exposure. And then we have a bunch of things on the roadmap, including options over the next quarter. We have a bunch of sort of new systems that we've built, and I won't go into the details of them, but basically to stop clawbacks, so that we make sure that that no one on the platform loses because we were unable to control the risk of another user. We have one centralized wallet. So if you want to, you can just put a bunch of stable coins in your wallet and then trade every single contract on the platform. And you never have to be shuffling things between 12 different wallets. You never have to be moving in the right spot tokens, moving out the wrong ones, or anything like that. And we have standard non-inverted futures. This is, I would say at this point we have 100x. In fact, we have 101x leverage on all of our futures. REST, WebSocket, fixed APIs, built-in OTC portal, and we also have a exchange token called FTT, which has sort of the normal suite of things. And there's a buy and burn of a third of the fees every Monday. You get fee discounts for holding FTT on the platform. We also have a few sort of unique things. One is that we buy and burn 1/10 of the insurance fund. And the second is that you get tighter OTC trading. So anyway, that's sort of a brief rundown of where FTX came from, why we started it, and what the product is like. And I guess I'll pass it off now, and happy to talk more about and answer questions once others have had a chance to give it a whirl.
Okay, thanks a lot, Sam. Just before you go, just a couple quick questions, just to put a little bit of what you said into a little more context. First, you said that China is the bulk of Asian volume. Can
Yep.
you put any more meat on that bone? Kind of approximately what do you
Yeah.
think it is? And are there, are there two or three other important countries, or is it just largely China?
Yeah. So I think China's, this is all sort of ballparked.
Sure.
Um, there's like, when I say China, what exactly do I mean? I could mean basically, mainland China only, or I could mean mainland China plus, well, if there's a mainland China UBO of a Singaporean company, what does that count as? But I, in general, I think China is probably something like 60% or so of Asian volume. So it's a huge chunk of it. But after that, there are a few other pretty large players. Japan and Korea, I think, are probably numbers 2 and 3 in Asia. And they each contribute a pretty decent chunk of volume. And after that, you have a pretty long tail of other countries that are sort of smaller, but on a per capita basis actually do trade quite a bit of crypto, including Taiwan, Vietnam, Indonesia, and a lot of Southeast Asia in general. And so in general, I think that like a lot of this is actually really just mirroring sort of the population and capital basis of Asia.
Okay, that makes sense. And the last question, and then we'll get to Joe. You mentioned that there were only 5 or 6 derivative exchanges. Is there a reason that there are so few exchanges, derivative exchanges, relative to normal exchanges?
Yeah, I think that the answer is it's a lot harder to build one. Um, if you sort of think about it, like the spot exchange, especially a stablecoin powered one, is actually a pretty simple product at its heart. Um, what goes into it? Well, you've got a matching engine, you got order books, and you got wallets, and that's basically the exchange. Um, and there's obviously a ton of UI features and things like that that get built on top of this to make the experience better. But at its heart, what are you doing? Well, you're depositing Tether, and then there's a Bitcoin Tether order book where you can buy and sell, and you can withdraw Bitcoin or Tether, and that's sort of the exchange. And so because of that, you just see like hundreds of copycat exchanges popping up, which mimic the features of the top spot exchanges. Um, on the derivative side, though, there's a lot more. There are many more degrees of freedom. There's also way higher requirements for risk controls and liquidity because of liquidations. The big problem is basically, you let someone put on a $20 million position with 10x leverage. Now, if crypto goes down 5%, that person's 5% away from going bankrupt. You need to somehow liquidate their $10 million position. If you can't do that in time, you can't find buyers of $10 million of futures before crypto goes down another 5%, all of a sudden you're going to start having clawbacks. All of a sudden there's going to be a loss on the platform. Users are going to have to compensate that, and that's really bad. And so in order to have a functioning derivatives exchange, or in general sort of margin exchange where you allow large size, you need a ton of liquidity on the order books, and you also need kind of sophisticated risk controls and liquidation systems and things like that. And so because of that, it's actually quite difficult to design a derivatives exchange that really functions well and is able to handle significant volume, whereas the core of a spot exchange is substantially simpler.
Okay, well, that makes total sense. So thanks a lot, Sam, for the presentation. Thanks for sticking around for questions at the end. And now, Joe, you want to take it over? This is Joe McCann, star day trader, and he also runs, as I said, Joe's Crypt, which is an awesome day trading Telegram group.
Thanks, Lou, and thanks for having me. This has been a call I've been looking forward to because of a lot of the stuff that's happening just in the broader crypto trading space. I think it aligns very well with the successful launch of FTX, and really excited about a lot of the products and frankly the leveling up that FTX is providing. But what I want to do is talk a little bit about kind of the future of crypto trading, and it has a lot to do with my background in trading and how that can actually translate towards call it more of a more modern or renaissance of active traders. But first, give a little bit of background about myself. I've been an autodidact trader and programmer for nearly 20 years. I started a company called NodeSource, which is the Node.js company. So I have a deep technical background, a lot of experience in open source technologies and enterprise infrastructure and distributed systems. Most recently, I was the head of quant trading at Passport Capital in San Francisco, California, exclusively focused on crypto assets. And most recently, as Luz mentioned, I've been actively trading and building out a set of proprietary indicators and signals of a platform called Cryptex and pro.cryptex.trade, where you can learn more about that. So first, let's talk a little bit about the current state of trading from a trader's perspective. There's still a lot left to be desired in this space. I want to go over 5 key points here. I would say we're still in the early days, not necessarily in terms of trading crypto or just the crypto asset space, but just in terms of trading, there's still a lot of, I would say, opportunity. I think FTX is tackling a lot of these, but certainly other folks are as well. And the number one thing I think that comes to mind, and Sam definitely touched on this, is liquidity. This continues to be a major concern for traders, whether they're size traders or they're, frankly, retail traders that, are trading anything but Bitcoin for that matter. And something happened recently, just over the past month, in mid-July, we saw the CFTC actually starting to investigate BitMEX. And where that may go, who knows? But at the end of the day, what we saw on July 19th and then subsequently thereafter was a massive amount of outflows from BitMEX. And so, correlation is not causation, but as we start to dig in a little bit more, you can see that volume effectively evaporated after that CFTC announcement. And so what that says to me is a couple things. One, BitMEX has a significant amount of leverage, for lack of a better term, or influence, I should say, on the broader crypto market. And frankly, if you're a large trader, you may not want to be parking a lot of your assets on an exchange that is now potentially being probed by the CFTC. So it makes sense that we saw a lot of outflows, but what we also saw was just a complete drop-off in volume with, relatively sideways trading. Whereas if you look at the month or month and a half prior, we did have a massive run-up from, call it 7,500 up to almost 14,000, but there was still a significant amount of volume. That CFTC news came out and it's just completely dropped off. So this is I would say a friction point for, size traders or, dare I call it institutional size traders that want to participate in this space, but are looking at the volume and frankly, the lack of liquidity and struggling to see sort of a path to improving that, or frankly, why they should be jumping into the space. The second key thing that is, I think needs to be addressed for the current state of trading is the operational risk with holding these large balances on exchanges. And I mentioned this briefly about folks moving, large amounts of assets off of BitMEX. This isn't just specific to BitMEX, right? So if you're an institution, a hedge fund, or a prop trading shop with serious size, there's very little to no way of hedging the operational risk of parking your Bitcoin or your other crypto assets on an exchange. And just for the first 6 months of 2019, we've had a number of hacks on some of these exchanges. Now, I won't go into whether or not these are what I would say best of breed exchanges, but you do see Binance on there. And Binance is arguably one of the highest volume exchanges, probably one of the most well-known exchanges, and yet they also have suffered from a hack. Conversely, Coinbase has not had an attack, but they have been dealing with an onslaught of potential attacks for all the reasons that everybody knows that people want to potentially hack an exchange. So my point here is that is there a product, is there some capability or feature that maybe a Lloyd's of London writes an insurance contract against the assets that you have parked on an exchange? Is there some other financial instrument or exotic derivative product that could be used to hedge, frankly, exchange risk? I don't even see that as an option for folks that want to try to find ways of hedging the operational risk of parking large amounts of Bitcoin or other crypto assets on exchanges. So in my opinion, this is yet another kind of point of friction for folks that want to trade crypto. The third piece, this comes more from, I would say, the institutional sides of things. There's very little to, frankly, no back office capabilities that exist for trading crypto. If you're a hedge fund, for example, and I'm frankly using a U.S. perspective lens on this, if you've been, say, a global macro or long short hedge fund for 10, 15, 50 years, whatever the number is, you're very much accustomed internally for your risk, your accounting, your compliance teams to actually know how to handle settlement, right? A stock exchange closes at 4 o'clock Eastern time every day, and you can evaluate your NAV on a very frequent basis. But this is a fundamentally different scenario where, what if you're staking tokens or you're running service nodes and you're getting, or you're mining, you're getting block rewards and it's landing in a particular wallet. How does an internal risk and accounting team manage that? I would say that this is yet again another point of friction, because it's not that, folks don't understand it. It's that the software or the tools or products or frankly even best practices do not exist yet for how a hedge fund or a prop trading desk or high net worth individual, family office, large asset allocator that's actively trading or involved in crypto, how do they actually sort of map that to this current environment for accounting, risk, compliance, et cetera. The fourth thing is this, I think it's probably more pervasive, not necessarily for a specific exchange, but just like broader for crypto in general, is that there are few exotic products, trading products. I know FTX again is tackling a lot of this. It's one of the things that I actually was drawn to FTX for as a trader, is that when I saw that they were offering the 3x leverage tokens, I thought to myself, finally, somebody is actually recognizing that, directions 3x ETFs that exist for trading on the stock markets need to exist for trading crypto. And that was, in my mind, kind of a light bulb went off and said, okay, these guys actually get it. They understand that there needs to be products that are targeted towards traders that will, frankly, inspire more traders to actually trade. Frankly, you could also use these as hedging instruments or certainly leverage speculative instruments. But moreover, the prime brokerage piece of trading, frankly, also does not exist or is very bespoke and specific. There are a handful of, I would actually say only a couple of folks that I'm even aware of, or companies that can provide, very unique market-making opportunities, lending. Certainly in the United States, lending is a very touchy subject when it comes to, providing margin or just broader lending facilities. So the prime brokerage piece around trading is still not fully there. However, there are a handful. Obviously, I've been talking about FTX. I didn't include them on this slide because they're relatively new, but these folks obviously are providing certain bits of financial instruments to provide for hedging and speculation. Each one of these has its pros and cons, right? So on the one hand, Deribit and Bix, Deribit is a Dutch company. BitMEX is out of the Seychelles. Frankly, aren't allowed for U.S. customers. Obviously, there are ways around that. And then on the other hand, you have a CME group, which is regulated by U.S. agencies, yet they close on the weekends, right? So you have a gap risk, if you will, by just trading with CME Group. So there's still a bit of a friction around even the folks that are providing things like options and futures and hedging products. There's a trade-off on either of those exchanges.
Hey, Joe, do you think that the CME Group will go 7 by 24 at some point?
Yeah, it's a great question. I've thought about this a lot. And, in my opinion, if you are serious about targeting what I would consider size traders in the space, you have to eventually go 24/7, 365. And the reason should be pretty obvious is that, and I'm sure Sam can attest to this, is that when you start to see some of the volatility that can occur over the weekends and the gaps that can exist where you're opening print on Sunday evening, if you're long or short, futures on CME, and it's gapping up 5-10%, that's pretty painful. And if there are other alternatives, well, traders will go to those alternatives. So in my opinion, it would only be sort of fiduciarily responsible for CME to actually start evaluating a 24/7, 365 model.
Cool.
Okay, so last bit here is this determinism is way more important than speed. And what I mean by that is, coming from trading, from the late 90s and early 2000s when high frequency trading really started to take off, it doesn't really exist, at least from what I've seen in crypto. And there's a couple of reasons why. One, as Sam mentioned, they've been a major liquidity provider across 30 plus exchanges. Therein lies part of the problem with high frequency trading, right? There is no one specific venue for trading. So if you want to buy Bitcoin or Litecoin or Ripple or something else, there's myriad exchanges that you can go buy on, and there are obviously arbitrage opportunities that exist in there. However, most high frequency trading shops have built their systems to adhere to a specification to an exchange. So they'll actually, write the code for the software to plug in co-located at an actual exchange. And so theoretically, you could still do this, but in my opinion, you're putting yourself at a massive disadvantage because you're pinning yourself to effectively one exchange where liquidity could be, thinner than, I don't know, BitMEX or FTX or OKX. And so that is putting you at a disadvantage. Furthermore, most of the high frequency trading strategies that worked in the, called mid 2000s or late 90s, early to mid 2000s had a lot to do with two things. One would be a rebate strategy where you would actually be the fastest person to provide liquidity to get the rebates. And that hasn't really been a thing until I would say most, call it over the past kind of like 12 months or so, we started to see a lot more of the, providing liquidity rebates start to exist. I mean, even on most spot exchanges, you pretty much don't get a rebate ever. They're charging you a fee whether you're make or taker, and that just wouldn't fly in the, I would say, traditional asset classes. The second thing though is, and I think this is, dusting off what happened in the late 90s and early 2000s, is a lot of the ECNs or electronic communications networks that were connected to the NASDAQ and NYSE provided specific order types that enabled high frequency traders to frankly front run other orders and be that liquidity provider or, frankly, push price in a particular direction to stop people out or whatever that thing might actually be. And I don't see that today either in crypto. These, sort of exotic or very specifically unique order types to enable high frequency traders to have an edge, they just don't exist. Now, again, the folks at FTX know those types of order types and know what that type of trading paradigm is like. So maybe FTX is one of the first to start offering that. But as it stands today, we don't see those types of order types available to, call them algorithmic or high frequency traders. And so what that says to me then is that deterministic order execution is actually way more important than getting some sub-microsecond execution speed. And that will change over time. But for a trader to know that, say, I think Sam alluded to this at some point, was, look, if I'm trading size and I'm gonna hit the bid for $10 million worth of Bitcoin, how deep is that order book? How deterministic is it that I'm actually going to get filled? What are the fills going to look like? Because there's going to be, myriad fills across that one large order. That's actually more important than making sure that you get executed in a sub-microsecond amount of time. And as more and more exchanges start to come online, this is going to be, I think, even more important as people want to be leaning towards determinism relative to speed. Finally, I think the last point I'll make on this is that the most quants or algo shops that are doing market making, they, you know, and I'm sure Sam could probably speak to this better than me, but, you know, there are, I would say, rudimentary approaches to how they can actually make a significant amount of money on certain ARB opportunities. A lot of it can be manual, a lot of it is automated, but it's very, very different than if you, say, worked at Renaissance Technologies or D.E. Shaw and you've been trading, say, you know, options or ETFs or something for a decade and trying to hop into crypto. It's just so different that the way that you think about trading from an algorithmic standpoint is more about determinism and less about the speed of execution. So that gets us to the future state of trading. And again, this is just my own personal opinion and based on, you know, my experience, not only in trading and technology, but also specifically with crypto. If you look kind of at the way traders have traditionally been positioned, it looks like a guy that's, you know, holding a giant iPad type device, standing on the floor of the NYSE, or maybe they're you know, a guy sitting at a desk at a Wall Street investment bank or you know, a prop shop like Susquehanna or Jane Street. That's not really the case with crypto. The traders in crypto, for example, or in my opinion, just the broader set of traders that are starting to come up, it's almost like a renaissance of traders is starting to surface, are folks that are more accustomed to, you know, playing World of Warcraft or Fortnite and kind of mapping that to crypto trading. And a lot of this has to do with the pattern recognition associated with trading. You know, if you look at, you know, the trading from the 90s and early 2000s, a lot of the trading that was still done around day trading was, you know, pattern recognition, tape reading, you know, some form of technical analysis. But it was very, very much heavily based on recognizing patterns. And that ultimately started to get commoditized away as we move towards machines and algorithms actually, you know, being faster, smarter, better than manual traders. And you started to see the specialists just evaporate from the NYSE floor because they were frankly no longer needed. And so this kind of, we kind of hit this, you know, kind of all-time low, if you will, of interest in trading or day trading, if you will, post, you know, 2008 crisis. And yet we now see a resurgence, or as I mentioned, a renaissance of interest in trading from a new type of trader. And so what I'm suggesting is that the trader of tomorrow is not going to be some guy that, you know, went to an Ivy League school and then went to Wharton and got his MBA and then went and interned at Merrill Lynch and then joined a trading desk at Goldman Sachs. It's likely going to be, you know, a 16-year-old kid that won $3 million playing Fortnite and has the sort of the mental capacity of pattern recognition baked into their brains at a very early stage. And so this is, you know, in my opinion, we see this move towards trading crypto being more like a video game than working on Wall Street. So if you look at Southeast Asia, for example, and this is testament to what Sam mentioned about the volume that exists in Southeast Asia, you know, day trading is entertainment there. And even if you look at a lot of the exchanges, even BitMEX, for example, they have leaderboards. The concept of a leaderboard would never exist on a Wall Street trading desk because it's meant to be more sophisticated trading, right? It's supposed to be this kind of highly held esteem version of trading. And so I guess my point is that as Southeast Asia makes up, call it 3/4 of volume, and they have a cultural phenomenon with trading being more like entertainment, I see this absolutely transitioning to places like Wall Street, which is one of the reasons why I ended up creating this platform called Cryptex, which is kind of the way I'm describing it is the cheat codes for trading crypto. If you're a young trader today, it can be daunting trying to understand every type of chart, every type of indicator that's on TradingView, not understanding how margin works, not understanding how leverage works, not understanding what a liquidation policy is, et cetera. And so just out of pure curiosity and frankly, abject demand from people that follow me in my Telegram group, I started exposing a lot of my own proprietary signals and indicators for folks to, you know, frankly, give them a leg up or give them an edge. And this is, again, feeding into that sort of that movement towards traders being more like video game players and less like sort of your traditional Wall Street iBank folks. So in my opinion, you can expect the worlds of the Fortnite World Cup and trading Bitcoin to totally collide. I think FTX actually is announcing something around this exact sort of thing. I don't want to steal their thunder. I'll leave that up to Sam and team at FTX to talk about that. But I would be shocked if we don't start to see the level of interest from folks that are playing games like Fortnite at a World Cup level with, huge prizes associated with it, absolutely transitioning to trading Bitcoin. Thank you. And I'm open to some questions, or we can move on, whatever you prefer, Lou.
Okay, Joe, that was terrific. I look forward to that collision of the Fortnite world and the crypto trading, if it's not already happening. Thanks for sticking around for questions at the end. And then hand it over to Michael Kaisley with Crescent Crypto. Michael, you want to take over the computer?
Yes, sir. 1 second, we'll pull it up here. Sure.
Rock and roll. There you go.
Is this, can you guys see full screen or part of my?
Where you can still see something on the right, the G Suite stuff.
Yeah, 1 sec. I don't know why it's cut in half like that.
There you go. Perfect. Well,
all right. I guess
you had it right a second ago. There you go.
Here we go. Okay. All right, everybody. So my name is Michael Kaisley. Just a little bit about me. Was a Cornell grad. Started my career at Goldman Sachs. Was there for 2.5 years on the investment management side. From there, actually left with a client. Was trading natural resources, equities, and options in a small hedge fund, basically prop trading. Joined up with 2 other Goldman alums in the summer of 2017 to start Crescent Crypto Asset Management. We're a little different flavor from the other 2 gentlemen on the call, although my background is similar in the trading world. We're an example of a crypto native institution. And so while we are trading and acquiring positions, we're much more of that buy and hold type of investor. One point that Sam actually made earlier, and it's true of the regular markets as well, is that we're the example of that small bit of volume that's true, US dollar wire, acquire Bitcoins, withdraw them type of mentality, which is much different. We're picking up positions for the purposes of holding them and holding them safely. So my first slide here is really more on just kind of the institutional market as a whole. This is not looking at futures necessarily, but this is talking about some of the pain points we discussed earlier, things like prime brokerage and how that works, settlement and operations. And it's been a really interesting exercise for me. I've traded crypto for a long time now. Back in the GOX days, it was 95% of total Bitcoin market. Now the market is obviously a lot different, even from 2017 to 2019. I think for a long time, the custody was looked at as a silver bullet. That solution now exists, but it's still not integrated fully into liquidity, settlement operations, reporting, taxes, audit. So I'm just going to go through what the market looks like at a whole for maybe not high frequency trading accounts, but for people who want to have crypto assets, store them, and from time to time have liquidity. This is maybe a step higher from that for people who are basically running hedge funds. So in the custody world, a lot of the traders, as Sam alluded to, what's really important here is quote unquote having the other side of the trade. Pre-funding, having assets in the right place at the right time are critical to being able to execute and get the liquidity that you need. So a lot of firms and funds and people hold balances on exchanges for immediate liquidity. That, of course, has its trade-off. It's a classic crypto trade-off, speed and security. Exchanges get hacked. Do not hold your exchanges, money on exchanges for any amount of long time. Anything you can withdraw, you should. The next best step, something that had a very long run, and I think Coinbase, Zappo, and some of the other guys are eating away at this market, which is self-custody on chain. These are traders or investors who are willing to withdraw from exchanges and hold on hardware wallets. That takes more know-how, not just setting up a wallet, that's pretty easy, but in terms of ensuring your redundancies, private key shards, secret sharing, and following the Glacier protocol. This third step is the custody provider solution. So this is something like Coinbase. All of our assets at Crescent are held on Coinbase custody now. It's a different sort of solution. Obviously, it comes with all the regulation from the NYDFS, and it gives us a central porter. It's still multi-signature, multi-factor, multi-step solution. That gives more transparency into our auditors, who are able to see our balances through things like view-only API keys. So the next step here is liquidity and trading. And so you're coming, the traditional way that people would trade or find liquidity is to pre-fund and put balances onto exchanges, crypto or US dollars, and trade crosses there into whatever they want and either hold the balance or withdraw. This next step, which is, not so new, but has been developed and there's been a proliferation of kind of new activity and competition, is within the OTC desk space. So, most OTC desks, I would say, and are principal traders. And what that means is if I go to a desk and there's many, and I say, I want to buy 100 Bitcoins, about $1 million worth, they can use their firm capital to purchase those Bitcoins and effectively deliver them to me. How they do it is up to them. They might be able to buy half of it now and speculate they can buy the rest of it cheaper. But what they're doing for me is locking in a price without having to move my funds from cold storage. So for anybody who's traded, the equity markets generally, this concept of DVP or delivery versus payment is really what we're trying to replicate on our side, which is near instant and anonymous liquidity without having to pre-fund or take a different type of counterparty risk. We're trying to take limited counterparty risk against the best institutional counterparties. An agency desk.
Hey,
yes, sir.
Michael, so when you talk about trading with OTC desks, is there kind of one primary OTC desk that you trade with, or are there a large number of them?
No.
And kind of what's the primary?
There's a handful. Yeah, there definitely could be more. The way that we look at it is, and it changes per asset and what the order is, but we'll always show it to at least two parties simultaneously and trade with the most competitive one. Sometimes it's three. So on something like a big Bitcoin dollar order, I'm going to flash three guys and they're going to give me their best looks and I'm going to take the best one. On something like a smaller asset where we're buying a large position, for example, in one of our custom mandates, we own in a single investor strategy. We bought over $1 million worth of Chainlink, and we weren't. That's like a top 20 asset, sub-billion market cap. Really only has two big listings in Binance and Coinbase, and even on Coinbase, over $1 million is a substantial amount of the volume. So in that particular instance, that was a good trade for an agency desk, but with the caveat to them, because the agency desks are then going around showing your order to their multitude of other desks on your behalf. And the instruction to them was, information leakage is important here, right? If you show all of your guys, hey, $1 million of Chainlink, one, I'm not going to even be able to buy the market you give me by the time it's made, because even the guys who aren't filling my order will buy Chainlink because they know that I am. So at times on more sensitive orders, it's important to narrow your focus or give good directive to an agency desk. But on highly liquid Bitcoin dollar trades, 2 to 3 counterparties, we'll see our order and we'll trade the most competitive print.
And I'll let you get back to your presentation, but real quick. And what's the situation with dark pools in crypto?
I know that Kraken supposedly has one, and I've never traded on it. I'd say if there's kind of one aspect that we interact with where we see a dark poolish feel, might be behind the scenes. So at times these principal trading desks might find a way to match me up or have inventory, so to speak, where they might be holding someone else's trade, which they can cross to me. And also in the agency world, there's a lot of kind of the inventory out there is known. And so you don't have you have transparency into what your print is, but on the agency side, it's anonymous both ways. They don't know who I am, and I don't know who they are.
Sure.
So in that sense, that is a dark pool, and that's the word anonymous is controversial in crypto, but insofar as it relates to liquidity, it's an important to know for the other side to not know who is the agent of this trade, and that's something that the paranoid think about when they put balances onto exchanges. That's not invisible. Hundreds of people know how many funds you have or what orders you could be working. So that's one of the benefits of a good agency relationship.
Yeah, exactly. And I apologize because I took up most of your time. So if you can, highlight what you think obviously is important, and maybe we have like time for one question.
Okay, I'll just rip through here. So the last bit is multi-exchange, central limit order books, few firms in that space, Tagomi, Omni, et cetera, where it's kind of a combination of the exchange feel, but more liquidity. Settlement and operations, this just goes to the options. The exchanges are more intense, more capital intensive to have your capital spread out in the right places. OTC, it's the same trade-off here. Some newer services are offering features like netting, which is something that's familiar to DVP traders, where I can buy and sell and trade my net P&L. I can fun with that. Reporting taxes audit. The only point here is that the voice only OTC desks don't really give you great reporting, especially for the high frequency traders. They know view only API keys are critical for fund administrators to be able to go back through, reconcile, give you a net price, and ultimately account this into your portfolio. I'll go on to my second slide here. It's just a quick snapshot of the Bitcoin futures market, including the CME and BitMEX kind of all on one page here. This is just yesterday's 24-hour volume, and I'm sure there's obviously more exchanges that aren't here. The futures market ultimately serve a different need for arbitrageurs, high-frequency traders, people who need immense exposure, even for the concept of short selling against the box. Moving crypto onto platforms is something that's risky, creates counterparty risk. This is the ability for someone who's maybe long with appreciated value, can put a smaller amount of assets onto an exchange, sell short Bitcoin for an amount of time. And in that way, maybe they're paying margin fees to do so, but they're also not taking the same amount of risk with 98% of their Bitcoin capital. I think in general, what matters here is how the indexes are priced. I think that's very important. I think that's why the CBOE futures ultimately failed. They had only Gemini, a pretty illiquid exchange, underlying them. Funding rate recalculation mechanism and interval is important. It's a big differentiator between a place like BitMEX and Deribit, who recalcs this funding rate mechanism more often, but that is a feature for arbitrageurs to try and eke out extra basis points. Liquidation mechanism Sam touched on, socialized losses, insurance funds, ensuring that happens as little as possible and having good risk controls. And the last bit is investor accessibility. The binary question here is that can U.S. investors trade on them? Legally, the answer is mostly no. So that's my run through.
Okay, that was Michael. That was terrific. I got to say, all three of you gave really tremendous presentations. I have no doubt that this is going to get viewed by a lot of people, and a lot of people are going to benefit from the stuff that you guys talked about. We just have a few minutes left. We have folks in the audience if you want to ask some questions. We've been answering them via chat. I don't think that there are any more outstanding. But what I wanted you guys to do is Michael, Joe, now that you've heard Sam talk a little bit more about his business maybe than you heard before. I don't know if either one of you had any questions about him and the roadmap.
No, one point that Joe made that I thought was really interesting looking at FTX today was actually some of the new indexes from a portfolio management perspective. It's actually where maybe the futures market overlaps with some of the accounts that are more like us, right? A day like yesterday where the market was down, there wasn't really a lot of good stuff that you could hold long or enact to have a differentiated position. So I think being able to own long the short products, even leveraged short products, is new and useful, and might find a place in different types of accounts, who aren't just focused on liquidity, but also looking for new products.
Yeah, I agree with that.
Yeah, one of the things in Samuel, still to a large degree, as amazing as what everything going on is, it still feels like I call it, radio on television. When television first happened, the first shows were radio shows with guys sitting at desks going, "Hey, now we're on television." And to some degree, I feel like that's where kind of we still kind of are on crypto, and that's incredibly exciting. We're there. I mean, that's crazy in and of itself. But now the question is, now we've got all these new technologies and a regulatory environment that could enable us to come up with all kinds of new things. How are you thinking about that?
Yeah, I mean, I think that, coming from traditional finance where index futures and ETFs were just like a huge part of the ecosystem, you get to crypto where it sort of is an obvious product to have, given that there are, thousands of coins, and they just didn't exist. And it seemed like, boy, like that's sort of an obvious need. Like, there are a lot of people who do want to put on a position in, mid-cap coins in general. And I think that there's like a lot more left there of sort of products that would make a lot of sense that just don't exist. I think the leverage tokens are one example, another thing that we made. But there's a lot more as well. I mean, a lot of people have been bringing up things like hash rate futures, Bitcoin dominance futures.
Oh wow, hash rate futures.
Yeah, and so that's an example
that
of like
great miners, right? Miners could
exactly.
use that.
Exactly. It's like a way for miners to actually hedge the thing that they really do have exposure to.
Yeah, that would help everything. Wow. Yeah.
Exactly. You can look at options in anything except for Bitcoin and ETH, which basically don't exist. You can look at general like structured products, ETFs. There's just this whole space of products that like traditional finance has been building, and also the space of like sort of crypto native products that people would have demand for. And then you look at the products that actually trade, and it's just spot markets and futures basically, and single coin futures, and there's sort of nothing else.
Yeah. Guys, so exciting. So last question, we got one from the audience for Sam or any of the guys. Are there any types of strategies you can share which take advantage of simultaneously trading several of the diverse types of products offered within FTX exchange? That makes sense?
30 seconds? I don't know.
Yeah.
I'll just say quickly, like, if you want to bet on, performance of altcoins against Bitcoin, you could, short sell the altcoin index future and buy the Bitcoin perpetual future. And that would get you sort of, overall crypto hedged bet on, altcoin performance. That's sort of one example of a thing that you could do.
Yeah, that's a great example, and that probably did that in 30 seconds. So really, thanks a lot, Sam, Michael, Joe. This was an awesome call, and thanks everybody for calling in. Bye.
Thank you.
Thanks, Luke. Bye.